Hey everybody, this is Jose here. We are about to start the session in 20-something seconds. Please, let's use this time for a sound check. It'd be great if you could confirm that you hear my voice. That way I know it's all good and we start on time. Thank you so much. Wonderful. Thank you so much, Charles. Very good. So 5 seconds to go. Okay, everybody. So I am just maximizing the introduction slide so we can have a proper launch of the session today. I will also show myself here in the bottom right of the screen. How are you, everybody? Important session today, my friends. Craziness in the marketplace, multiple sessions in a row, isn't it? And I'm pretty sure that depending on how much experience you have trading, you are wondering, what do I do now, right? So we're gonna certainly look at the markets and get to understand the environment, and of course look for opportunities as well, because this environment is certainly source of opportunities too, right? So we'll talk about everything else. Chat box, Pansy, how are you? Good to see you. Mark, good to see you. Three, good to see you. Leland, very nice to see you as well. Dirk, how are you? And by the way, yesterday we had a little hiccup with the calendar, isn't it? And some of you maybe were waiting for the session, so actually it was today. Okay, so sorry for that. But anyway, welcome to the session today, 12th of March 2020. My name is Jose Blasco. I will be your guide. Today we're getting together to look at the markets from a little bit of a longer term perspective. We are normally looking for swing trades, normally utilizing options, both in the directional approach as well as the non-directional approach, looking for all those different types of opportunities. And today will not be different in that sense, even though at the beginning of the session, I want to look at the markets from a little bit of a broader perspective, okay? Disclaimers before we start. The following video clips demonstrations are for educational and instructional purposes only. Traditive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. And this is the disclaimer. So the session is now officially introduced. Therefore, here is a TradeStation ready for us to begin with some planning, some analysis, and so on. Okay. And as I just said, let me take a look at more potential questions, comments. Royce, how are you? Marcus, nice to see you. Yeah, good to see you. You are right. It was a long time we didn't see you around live, and certainly you were missed. So it's good to see you, Marcus. Anyway, so going back to the markets, okay? So, I mean, I think that the chart says it all, kind of, right? So when you look at the size of those candles, it's pretty impressive, okay? It's pretty impressive. What we have in front of us, it is not a joke. It's certainly not the first time that this happened and not the last time it will happen. But certainly, it's powerful moves to the downside. Futures markets hit the other day and today again, circuit breakers. Some UFOs are traded through like they were not even on the chart. And this is certainly identifying a massive change of behavior, a massive change of climate among investors, massive amounts of orders to buy being removed from the marketplace, orders being canceled. And that's why the market is falling so hard and so fast. Okay, and that's what's happening. So first note of advice here when it comes to how to deal with a market condition of this sort. Well, certainly, first, management of emotions. Okay, so some of you may have positions, some of you may have a portfolio. The whole thing is moving against you. It is very, very easy to go ahead and fall into revenge mode trading. I don't know how to put it. It's an extreme situation. I mean, if we were to go back in time to look at when was the last time we had a very big move, it was here. Let's go to October 18. But when you look at the size of this move compared to the size of this move and the amount of days it took, I mean, the violence present nowadays is way greater, right? So if you look at the movement, at this, the quantity of the move, I should say, the length of the move, and I'm just gonna look at the percent and also look at the time span, okay? Percent and time span. I will make this of a larger size, okay? So we are talking about here 20% drop in 97 days. Let's call it 3 months, where the situation that we are facing right now, it's from here. I don't need to be that precise, but basically from top to bottom is like 26% drop in 21 days. So it's more than what happened in 3 months like last year. This is basically done in 3 weeks time. Okay, so it is certainly impressive. And if you have a portfolio where you had many long equities, then there is a big problem there if you didn't have any management when it comes to stopping yourself out, or as we discussed in other sessions before, having some hedging positions, okay, based on the climate on the S&P, isn't it? When the climate went red, you should start having, negative delta position in the portfolio. And then when this is happening, actually that would pay you. But unfortunately, managing a portfolio at that level normally implies a great level of training, a great level of experience, a lot of practice. And I would expect that even though I do know that some of you are that veteran trader, I would also expect that many of you may not have developed that experience yet, and therefore may be in that position where, oh my God, what do I do? So again, first note of advice, emotions cannot be deciding what to do. Okay, emotions cannot be deciding what to do. You need to cool down, look at the situation objectively before taking decisions. Okay, and this goes in both ways. When it comes to taking decisions to close positions, as well as when it comes to taking decisions when it comes to entering positions. So out of fear, you may say, I'm just closing the whole thing. And next thing you know, the market bounces back 20% next week and you just miss the whole thing. So you need to have a plan. You need to have a proper analysis of the market in an objective manner to decide what to do next. Okay, that's first note of advice. When it comes to entering positions too, some of you may be like, oh my God, it fell already 20+%. No way it's going to keep falling. So that's it. I'm in pain. I got multiple positions that are problematic. I'm just going to load, my portfolio with high quality companies. For example, you look at Microsoft, which is a, company that you would expect it to have good fundamentals. It's approaching green UFOs. It's fell so much. It's very easy to convince yourself and start thinking, no way Microsoft would keep falling. I'm just buying a lot of Microsoft plus they pay dividends. That's it. I'm just going to load my portfolio with Microsoft and recover. Okay. Well, it could make sense, but only if you have a plan around it. If you were to take such type of decisions in your portfolios out of emotions getting out or emotions getting in, this is the recipe to get into a deeper problem. And this cannot be the case. Okay. So more than ever, we always need what I'm about to say, which is a plan. We always need a plan, but more than ever, you need a plan now. Okay. And if, let's say right now you are realizing, you look at yourself in the mirror and you realize that it's not possible for you to take a decision which has not emotions, then, you gotta find a way to cool down before you take a decision. And this may be, close your computer, go for a run, go for a walk, go do something absolutely different than what you always do, and come back tomorrow with a fresh mind. And then you take a decision tomorrow. Yeah, do you have one more day of market risk? Yes. But if you take a decision which is emotional now with no plan, it's a gambling situation, right? So again, if you happen to be in a problematic situation, don't add more problems by gambling. Find a way to cool down so you have a proper decision. Okay. So that's the first note of advice I would like to say. Now, having said that, let's look at more parameters out there. So first, I want to look at the VIX. Okay, so the VIX is pointing at 60 pluses. Okay, we have not seen that since 08. Okay, we have not seen that since 08. And to be honest, this is bringing me back in time many years ago. The 08 is when I personally started learning how to trade, and the levels of volatility, we had, important peaks of volatility at those moments in time. And I remember talking about it the other day in one of the sessions. But the levels of around 70 VIX, we have not seen that. We have not seen that since 08. Okay, so could go higher. It went higher. It went around 90s. Okay, at that moment in time. But again, that's not a competition. My point is that this is not a joke. What is happening in the market right now? It's authentic fear. We also know computers trading algos, increase the speed at which fears build up. There is a lot of volatility on the marketplace. So if we also look at the S&P, for example, and we look at a daily time frame of the S&P. And for a minute, instead of the S&P, I'm just going to look at the futures because it's a much more representative of the real situation in the marketplace. So if I was to add, okay, I'm just going to add the average true range. Okay, so looking at the average true range right here. So, okay, let's make this purple color so we can see it on the screen. The yellow doesn't work very well with the white background, isn't it? So notice the average true range at this moment in time. So if I make this chart to be very compressed, right, and if I was to look at kind of like the top of volatility conditions is around 70 points a day when things get spicy. The bottom part of volatility, it's around 20 points a day. Let's say an average move on the S&P, it's let's say like 25% of that range, like 30 points, 30 something, when it's nice, 20 happens very often too. But right now we are dealing with 167 points. So, I mean, this level of volatility absolutely justifies the levels of the VIX. Okay. It's not a crazy thing. The question is, why is this happening? Okay, why do we have such an increase in speed of movement? Okay, well, yeah, the easy answer, if you were to read a kind of like an old school book on trading theory, you would be probably told in those books that two emotions drive the market, which is the fear and the greed, and there is a lot of fear now. Okay, and I'm not saying that's wrong, by the way, but I'm just saying, we need to add another component which has nothing to do with emotions because it's computers. That didn't exist many years ago, but they do exist since many decades now. And those computers are doing a lot of short-term trading at the speed of the light, taking many trades. Okay, because you could expect, think about a 1 minute time frame, right? Or think about tick charts or volume charts, and you pick 200 shares, of a time frame, right? 200 share bar. So in a normal day, that would be very little movement, right? Very little movement. But in the days like now, that's a lot of movement. So computer trading could take those tiny moves, which are not tiny any longer, and do millions of trades a day. Just creating so much more trading, so many more orders coming in the market, and creating a lot of movement. Okay, and this is certainly something that is happening as we speak, and is one of the reasons why there is so much movement, just like it happened in 2008 as well. Okay, so we have a volatile situation in front of us. It's authentic. Okay, it's not a joke. It's in front of us, and as traders, we need to be aware of that. And not to fight it. Okay, something again coming back to notes of advice. Okay, and after this last note of advice, we'll begin looking for opportunities. So I remember when I was learning how to trade myself, and I told you a minute ago it was 2008. I remember there was one day I was in class and we were looking at a stock, and that was Bank of America, BAC. Okay, and I just wanna get here into the monthly time frame. Okay, and you can see in 08 Bank of America went as low as 280, okay, or 260 or something like that. That was how low that stock went in 2008. I remember being in class and the stock was around $6 a share, something like that. And I remember there was a student that was 100% sure, and maybe the reason is because in his prior life he used to be an employee of Bank of America working as a clerk, and there was an emotional connection with that company, and probably also he owned plenty of shares of that company, having been an employee. So there was a huge emotional connection with that stock. But I remember that gentleman have a very strong opinion about. I remember he said, using strong words, he said there is no way Bank of America goes below 5. That's what he said, and it went below 5, actually 2.6, which is kind of like half of 5. Okay, so if that gentleman, saw Bank of America fall below 5, 4, 3, give up and sell everything at 3, the pain was tremendous just to see then Bank of America going back up, to levels of 30 at some point, right? So again, my point is that we need to put emotions on the side. We should not have any type of belief of any sort, and just rely on objective information on our screens together with an objective trading plan, and act on the plan where when we lose a limited amount of capital, and when we profit, we expose ourselves to the market to try to make more than the money we made when those trades were not successful. And by doing that, no matter which market conditions you would be in, you should be okay. Okay, and of course, the current market condition is a major magnet for emotions, and you may have all sort of temptations. Okay, some of you may be like, okay, you know what, forget about it, I'm just gonna sell a million puts at 14, because if Bank of America drops at 14, I just want to buy Bank of America at 14. So I want that stock to be put to me at 14. I'll sell a million puts, right? Well, it may be a great idea. Fundamentally, it may be a good company. You have unfilled orders to buy, etc., etc. But this is what I would kind of call a little bit of a hopeful action, in the sense that how many times you have been able to go back in time and backtest such a situation and see what the reaction would be, right? So again, have a plan, manage your emotions, and whatever you do, no matter how extreme the market condition is, don't divert from your plan. Okay, don't divert from your plan. This is the bottom line. This is basically my message for you today, starting the session in such a day where today we got circuit breakers hit multiple times, even before the U.S. market started and right after the U.S. market started, and then again. So you need to be aware of this and keep it cool, or don't trade. Okay, if it's too challenging, find an activity that cools you down and come back tomorrow with a fresh mindset, so you don't make any mistakes, because this is the typical days where you can enter amazing trades, but this is also a typical day that then you can regret so much. Okay, so make sure you are with me on this message. And by the way, even though it's been a long speech since we started, like 15 minutes stop, asking you to be careful out there. Again, it's an important day, guys. So I would like you to go ahead and give me a little bit of a confirmation there on the chat box that you are with me on that. And by the way, if there is any comment, okay, if you have a what if, right? If you have yes, but blah, 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 please type it in so we can talk about it, okay? Because I want to make sure that I help you have the right mindset in such a market condition that does not happen often, okay? Thus, we don't have an opportunity to be in front of the market like all of this is happening like today, okay? Cool. Okay. So having said all of that, and while I'm looking at your comments and messages on the chat box, and again, you don't need to agree with me, okay, guys? I'm here to help you, and we can brainstorm about it, and we can have a healthy conversation where I said this, you said something else, and this brings us into a little deeper conversation. And as long as this help us all, it's great. Okay. So the markets are not black or white, and I'm just sharing experience, and what I would think is it's safe, okay? But at the same time, I am not an oracle that knows everything that's going to happen in the future, okay? I'm just talking about trading based on my own experience, okay? Yeah, Mark, I hear you, my friend. I hear you. Maria, I hear you. Yeah, Lisa. Yeah, thank you for your wise advice and experiences are greatly appreciated. Thank you so much. Thank you very much. Dirk, let me see your message. All good. I don't envy those people who have a company for 1K and they just can see it go down and can't stop it. They have to rely on the management. Yeah. Andrew, hello. Sorry, I'm late. You're fine. You're fine, Andrew. We are starting now. Actually, we were just talking about the markets. Yeah, you're right. I mean, the beauty, of dealing with the real-time markets, the beauty of dealing with derivative products, having a trading platform, having the opportunity to click the button ourselves, enter order, cancel orders, use stops, all sort of things, that is to us a given. But all those people out there, which are a million, that don't have the tools to be able to manage, and they're just relying, hoping for the best, just like that's what the market is doing. I cannot do anything about it. So the people that are in those situations, really, it's very painful for us to observe, given the fact that we know tools that could be used otherwise, and not everybody does. Okay, so yeah, definitely. Let's share our knowledge out there with the people that we love and the people around us, and let's try to keep them safe, even though, of course, if they are invested in some products where little can be done, such as a 401k, mutual funds, unit trusts, etc., then that's what it is, But yeah, certainly, at least let's try to have all those people to avoid them falling into hope, because hope is a normal human emotion that is triggered unconsciously immediately the moment something is painful in front of us. Okay, and the problem is that it's subconscious. Many times we don't realize it. Okay, so yeah, very good. Okay, so now let's get back to trading. Okay, so as always, directional trading. Okay, the two rows on the top: directional long, directional short. Okay, and then we have our non-directional trading with pure non-directional, and then we have the credit spreads to the upside, the credit spreads to the downside. Okay, the neutral long, neutral short. So four types of opportunities. Okay, so the first thing I would like you to notice is when I click on directional long, I got nothing at all. Okay, and what does that mean? Well, the whole climate for all the stocks that are part of the scanner, together with the levels of premium in options, having a VIX located at 69, well, the scanner basically doesn't find anything that is anywhere close an up climate for a trade to be taken. Okay, even trades that we had placed in the past. Okay, I just want to bring Option Station Pro. Here we go. For example, I remember recently we entered a trade to the long side that was BMY. Sorry for that. Bristol Myers. This trade is deep in the red. Okay, this trade is deep in the red because obviously, given what just happened, there is not much that can be done for that particular stock. The whole thing went down. Market going down like 7-8%, up to 9% in the futures markets earlier is bringing everything down. Okay, so let's begin with understanding directional long. I want to take a look at the trade that we have running, at least the one I have here in my account. You guys may have more. Hopefully, you guys are working on a proper portfolio with long and short opportunities. So you have some longs that are producing a little bit of pain, but you also have some shorts that are offsetting the problem. Okay. So what do we have here with Bristol Myers? Okay. Well, notice, okay, that we pay $94 to get into this trade. Okay, that was the trade price. Okay, and Bristol Myers went so much against us, okay, that currently this trade is losing 88.5. Now, we still got until the end of April, and you never know. And by the way, we've seen it many times, and I said it many times, that when something moves fast in one direction, it may move fast on the opposite direction. So this move to the downside, we may see a bounce very, very efficient, okay, from now until the end of April. We still got like a month and a week, something like that. And next thing you know, we are kind of back to in business with Bristol Myers, okay? But certainly getting to meet our final target, I don't think that's going to happen at all. Is that making sense? So one thing that we could do with Bristol Myers that, since we entered, I believe it was somewhere here, okay? Went a little up, a little down, a little up, and then all the way down, okay? So one thing that we could do is take a look at, okay, what the strike was, which is 70, okay? Where is 70 on the chart? Well, 70 on the chart is up there. Okay, it is not looking like we will travel up to 70 from now until the end of April, given how fast price moved. Okay, in the opposite direction. Plus now you have UFOs. Okay, plus now you have a down climate. Okay, which is not even close to exhausted. 5 out of 6. So again, it's not looking like this trade will end up doing anything amazing for us. So what is it that you could do with Bristol Myers? Well, you can go ahead and, keeping in mind we're using April 17, you can get into April 17 right here. Okay. Oh, sorry. I'm like, this is many expiration days for Bristol Myers. I was actually charting the S&P. Sorry for that. So I'm loading Bristol Myers now. Okay, and we're looking up at April 20. We can see the volatilities are quite high, 58 in this case. Okay, 92 in the front week, 73 next week. Okay, and unfortunately, as you know, our 70 basically got crushed. That's why we are losing $88 out of 94. Good news. there is no way we can lose more than 94. So the risk is well contained, as we knew from the beginning part of this trade. And here, the one thing that you could do in the following days, okay, because here is what tend to happen when the markets crash hard. Okay, so when the market crash hard, then the bounce hard. Okay, so the move from here to here, okay, to the upside. Okay, so if I show you the percent change and the net change, that was one day. Okay, so that was 9% in one day, which is $5. So in other words, currently Bristol Myers is trading here at 52. Okay, it's trading at 52. It may go back, let's say $5 up. Okay, in 1 or 2 days, if we have a very strong reaction after the drop, which is quite a pretty normal thing. Okay, and therefore the 72.5, okay, would become kind of equivalent to the 67.5. In other words, you may be able to sell an option against the option you own and collect, maybe $14, maybe $20, something like that. So in other words, let me write this down on the chart. It will be easier, more easily understood. Okay, so one thing that you could do here is let me write it here. So we purchased. Okay, so we are long the 70 call that expires in April. Okay, April 17, 2020. Okay, this option cost us 94 cents. Okay, that was the cost of this option. Okay, per share. That's $94 per contract. Okay, so if we reach April 17, 2020, we will lose $94. Okay, if this doesn't go above 70 before that date, April 70. So one thing you could do is like, okay, so what is the strike above the 70? Well, the strike above 70, as you saw on the spread on the option chain a minute ago, was the 72.5. So you could go ahead and plan on using the 72.5 call, and what you could do is to sell the 72.5 call against the 70 call you currently own. Okay. Now, not today, because today it's paying you nothing. But if, let's say, in the following day, the market bounces up like, $5, $6, whatever. So you may be able to sell the 72.5 call for, let's say, I'm going to say $20, okay, or 20 cents. I'm anticipating that. I don't know if that's going to be the case, okay? But maybe you would be able to do something like that. And if you were to be able to do something like that, okay, so what's the beauty? Well, the beauty now is that by doing so, your net cost, okay, so if you were to do so, your net cost would be reduced by $20, and therefore the most you can lose is $74 instead of 94. So you can mitigate a little bit of pain by selling a call against the call you own. This trade is extremely unlikely going to become a profitable trade, but you could remove a little bit of the pain if you have one of those very strong bounces, okay? Which again could happen very well. Okay, so I know some of you are in this trade. I would suggest that you look at it. Okay, and Lisa, I hear your point about earnings being on April 2nd, and in this case, given the fact that that stock went against you so much, to be honest, it doesn't even matter that earnings are going to happen on April 2nd. Actually. Earnings on April 2nd may be the recipe for a nice gap to the upside, and that would allow you to sell that call, or maybe come closer to a point where you could exit the trade for less of a pain. Okay, so again, this trade is not going to end up to be profitable. I would be quite shocked if that's the case. It could be, you never know, but I would be quite shocked. But at the same time, you do have a couple of opportunities there to reduce a little bit of the pain. And again, we never trade one trade at a time, isn't it? When we trade stocks, so you run a portfolio with multiple trades running in parallel. So this is an opportunity to reduce a little bit of the risk or the pain of this trade while you run other trades that hopefully are profiting for you, and overall your portfolio would survive and deliver some performance. Okay. Let me take a look at Marius. Marius said, "All good, Jose. Based on your time frame that you are trading off, the clear indication is down. Why we would even look at buying opportunities when the clear product resistance is down?" Well, Marius, it's because you want to have a diversified portfolio, and when I talk about diversification, I mean a diversification based on deltas. So I'm just gonna bring here a web browser, okay, so I can show you um, a place. Okay, you may want to watch this video because I get your point. Okay, but the direction is so clear. It's like, okay, why don't we just trade that direction? Well, yeah, but precisely, I mean, first of all, anything could happen anytime. So a direction that is very clear could change. But precisely because the move is so intense in that direction, you could have the volatility is so great that even a small correction to the upside could provide amazing profits to the long side as well. And what if the market just V bottoms and goes back up into a new up climate and starts making all times high again? Because 3 weeks from now, there is some sort of a medicine that was released by someone that now, really produces a great relief to people that got the coronavirus, and things go back to normal very quickly. So, I mean, we don't know what we don't know. So as traders, we always need to manage the risk, and betting in one direction only would only be justified if you take one trade at a time with no overnight risk. And again, if you do intraday trading with futures or Forex, then I get it. But if you're going to be running stocks, which is a market that only trades 6.5 hours a day, where a lot of things happen when the market is closed. I mean, today the market up and down already like around, I think was it like 5% down or 5 something percent down, and then went to 7% until it hit the next circuit breaker. I think that those were the figures, if I'm not mistaken. So again, that would be very, very important. Okay, so here I'm pointing at the sharpening session here, a sharpening playlist, and I would like to point at this 2-hour 42-minute video on hedge portfolios, as well as another 2-hour 29-minute video when it comes to gamma hedge. And I know I'm a bit demanding when I send you to watch those very lengthy videos, but again, it's important stuff. Okay, so you may want to go take a look, understand the impact of kind of have a portfolio that only points at one direction versus using the beauty of options, where you can diversify based on deltas, where on top of that you got a beautiful gamma. Okay, this is probably my favorite Greek. Okay, gamma. You have the beautiful gamma, which is kind of like the forgotten Greek, because people will feel like, oh my god, gamma is too complicated, let's focus on theta, let's focus on delta. And people don't talk much about vega, gamma, especially gamma. Most people don't talk about it because it's a second derivative, and people will be like, oh my god, too complicated, right? Well, it doesn't need to be that complicated. Okay, and I think that those videos show it, that it's not that complicated, and it does give you an edge. Okay, or it gives you an edge, and in this case a hedge too, right? So again, I would recommend you to watch that. Okay, so that's why, Marius. Yeah. Yeah, Lisa, your plan makes sense, again, because the earnings could be a recipe for one of those major gaps, and then sell options against your long call and offset the problem as much as possible. Okay. Now, remember as well, during the earnings, the volatility will drop heavily. So you may have a gap in your favor, but then the options that you want to sell pay very little because of the drop in volatility. So that's why I was pointing out, if you have a strong bounce going back up, like tomorrow, the day after, which could happen very easily, that in my mind would be a better time to do it instead of waiting April 2nd. Okay, your plan makes sense too, but you may get that penalty on volatility drop. Okay, cool. Jose, have you done any new session using the INV scans? I'm not sure what do you mean by INV scans. If you could let me know about that. I would like to fully understand what you mean there, Lisa. I'm not sure. Anyway, so guys, so let's continue. So again, no opportunities to go long, not today. Okay, tomorrow, next day, there may be some opportunities. You may need positive deltas to offset the portfolio. So look for those, not today. To the short side, we got a collection of stocks. Okay, we got a collection of stocks, but I would not want to start with directional opportunities today because of two reasons. First, most of the stocks look like that one falling down. Okay, so even if I look at the 55-minute time frame, like for example, here we got Tesla. So let's look at Tesla, 55-minute time frame. So what's going to happen? First, many stocks are going to have an exaggerated climate, 13 out of 5. Okay, so it's too stretched, and this is the times where we clearly see the old saying in Wall Street that the market can remain irrational longer than you could remain solvent, right? So we don't want to fight anything, but certainly trading against probabilities makes no sense either. Okay, so this is the direction. That's what it is in Tesla, and that's why the scanner is giving us an opportunity. At the same time, for us to take that direction, we need Tesla to retrace back to 660, right? And 660 would be around there. Okay, and let's pretend there is a UFO at this price level where you still need to wait for price to come back and then take the short and write it back down. In other words, that's going to take time. And because the market started the day dropping like 8%, Tesla is falling 13% in one day. So basically, we are late to the party here, and I won't be able to plan on a trade meeting entry as of now. Okay, so that's why I prefer to start today with non-directional trades, and also because the VIX is 69. And the other thing that we know about implied volatilities, okay, and I want to show you too, okay, because again, today, guys, today is supposed to be a trading day, but I'm basically running a mix of educational and trading at the same time because it's a unique situation, and certainly we need to talk about it. Okay, so we need to talk about this. So it's a little bit of a mix between a lecture day and a trading day today. Okay, so take a look at what happens when volatility goes up very fast. Okay, what happened next? Okay, so you may have drops of volatility. Okay, you may have drops of volatility. Okay, of 48%. Okay, in a few days there, right? So let me move this. Oh, I cannot move it. Okay, so yeah, anyway, so that's a few days. Okay, a few days, 47% down. Okay, or this one here. Okay, from here to here, like 30% down in 18 hours. So imagine the price of an option. And this is an oversimplification. What I'm about to say is an oversimplification. But imagine that you sell an option, and 18 hours later, the price of that option is 30% cheaper. In other words, if you close it, you make 30%. Just because the value of the option went down, just because everybody went from fear to relax. And why do people go from fear to relax? Just because the market stops falling and bounces a little. Okay, so again, it gives us a great advantage to sell options when people believe the world is ending. Okay, I mean, let's face it, the situation right now, okay, may not even sound funny when I mention things such as the world is ending, because there are actually people that are very sick as we speak, and I'm certainly very respectful of that. But the reality now, putting that on the side, and again, moving emotions away from our thinking, putting all of this on the side, the reality is that the market went through worse things, worse, where even more people dies. And what happens in the end? Everything continues, right? So in other words, as traders, we need to keep cool, and when there is an opportunity, we need to capitalize on it as long as the opportunity meets our rules. Okay, so that's what we have today. We have a high volatility situation, and the scanner does report some stocks meeting the rules for a non-directional trade. So I'm going to look at it. And the first one to check is Costco. Okay, that's the first one to check, Costco. So I don't know if it will be a valid trade or not, but based on the scanner, it meets the rules. Okay, and the scanner is basically a computerized calculation. So in other words, I'm not thinking, I'm not feeling, there is no emotions involved. It's an objective type of decision. Okay, so what do we have with Costco? Earnings took place on March 5. These already passed. The next earnings will happen on May 29. Okay, so there is no earning anywhere around the current date. But still, when we look at price action, even though it's very volatile, okay, the criteria from the scanner reports Costco as a valid stock for us to plan on a non-directional trade. Okay, so great. So let's plan it. Okay, I got plenty of UFOs below. I got plenty of UFOs above. Okay, so we may have a trade here to be planned. Probabilities are 53%. If I was to look at pre and post market, 53 becomes 57. Okay, which is even better. Okay, now we don't find UFOs anywhere close in the bottom side, so it seems logical to think about using regular hour data, regular session data, because it's just good enough. Okay, we want for non-directional trades, we'll take anything 48% and above. So I'm just marking those UFOs just so I know they're there. Okay, and going back to the regular session, notice that those UFOs actually coincide with the UFOs that we have there too. So actually, I don't need to keep the purple lines. So, plenty of UFOs below, plenty of UFOs above. Bottom line, we got a potential opportunity to do an Iron Condor. So what are we going to do? Okay, well, even though the world is crazy, because it is, we are just going to type Costco without even thinking about it. We are just going to approach it mechanically. Okay, looking at volatilities and so on. Of course, it would be ideal to be able to do a trade using next week expiration. Okay, sorry, not next week, next Friday expiration. We got 99% volatility. Now, let's take it easy there, because we also know the from week, especially when we only got 1 day and a half to expiration, we are dealing with fake Greeks. And I don't mean they're fake, I just mean they are distorted. Okay, so that creates this false 97%, which looks amazing, but still the next one is 79%, which is also amazing. So we're gonna go ahead and look at everything. I'll start with tomorrow, because again, the crazy amount of volatility may allow for us to do for us to do so. It's not always the case. So I'm gonna right click on Iron Condor, analyze and sell an Iron Condor. I got from a prior session, I got my plus standard deviation above, my minus standard deviation below. This is telling me that using tomorrow's date, which is March 13, Friday, that stock, which is currently trading at 280, may move to 296 or 264. Okay, so, well, I need to move into my chart here, 296, and there are UFOs, okay? So 296 is right there. So if I was to sell anything here, it would be above 303. So before I spend much time on this trade, I'm just gonna go ahead and look at the 303 to see how much I get paid. That would be 302.5. And notice that this seems to be paying us 60 cents, okay? 60 cents. So it is certainly more, even though this is not a very liquid strike, as you can see, okay? But we may get filled at the midpoint, okay? Especially when options are not too liquid and you see the widespread. It's certainly not ideal, especially if you plan to use stops, okay? But when it comes to getting filled, many times market makers will end up, just for us, okay? Just for your one trade, they will end up giving you the fill because they may not have too much volume traded. And every trade is also exchange commissions, arbitrage opportunities, maybe getting out of another trade that they have. And, many times you will be surprised and you get filled, in this case at 59. So 59 is way more than 35, which is the premium that we require. And therefore, this may qualify as a valid trade. So, hey, this justifies me working deeper on the chart. And I'm going to look at planning a trade on Costco using tomorrow expiration. And when I'm done with that, because it's such a short period, and I got more UFOs, right? And the second expiration also provides great premium. I will also look at how does it look like with the next expiration date and see what's best, okay? So for now, I will say that on the upper part, okay, I will be looking at 303 as the bottom part of this range. If I was to calculate the vertical distance from those UFOs, sorry, I just did the opposite I was supposed to, which is instead of on check, I did check. Here we go. So now if I was to measure the vertical distance to the bottom side, so basically we are dealing with those UFOs below. And remember, I need at least two. Therefore, my purple line will be located right there, and right there is 255. Okay, so how much I get paid for the 255? So the 255 would pay me 42. Okay, 40. Okay, pretty concerned about the liquidity here. So the trade looks good, but we may not get filled. Okay, now people are selling at 68. So if you bid 30 something, you may get filled. Okay, as I said before, but it's looking complicated. In any case, let's put it together. So we said 255 for the put side. So we're gonna do 250. Oh yeah, no, okay, it's not gonna work because we're gonna have five points, 5 points, which is the distance between the strikes. Okay, on the upper part, notice how I do have 302.5 and 305. The bottom part, I got 255, but I don't have the 252.5. So in other words, if I sell this option at 25 and I pay this option at 15, that's going to give me a net credit of 10, which is very tiny to justify the risk of $5. It doesn't make sense at all. Okay, so again, the lack of liquidity on the March 13, finally, it's basically invalidating the trade. So we're going to look at March 20 to see what's going on. This is the monthly expiration, by the way, so we should see much better liquidity in this case, which is the case. Okay, 475, 610. 542. This is way, way, way larger levels of premium. Okay. Now, of course, the date being further out also implies the price points to be further out. So let's change this to March 20 and see what the calculations suggest. Okay. So March 20, right click, analyze and sell, and around Condor. And the calculations are suggesting now not 303 anymore, but 317 and 248. Okay, so let's take a look at the 317. If I sell the 317, I need to load more strikes. So I'm going to load 30 strikes. So 317 and a half, that's going to pay you 220. So it's plenty of premium. Okay, that's nice. Okay, and 240 or something like that is going to pay you 218. Yeah, I'm not too happy to see this. Okay, seeing $5 price strikes increment there really don't make me happy. Okay, but anyway, let's keep working on the plan and see if in the end we gotta go or a no go. Okay, so 316 first. Let's look at the chart. Where is 316? So 316 would bring me. Oh, I just got the wrong element on the screen. So 316 would bring me up all the way here. Okay, because 316 is somewhere here. So that would be 325. That's the option we would be selling. And again, if I was to calculate the vertical distance from the current price to 325, and I was to project this to the bottom part, okay, so basically, okay, we are dealing with that UFO right there. Okay, so we are dealing with 325 and 238. Okay, so I want to go back to 238 is below 240, 325 is above 317. So 325, I need to load more strikes. Let's load them all. So 325 is paying us 134, okay, which is good. And the 240, it's paying us 280, which is good as well. Okay, good. Okay, so this is a good starting point. So let's begin adjusting the calls, which is going to be 325 and the one above, 327 and a half. Okay, so 325 and 327 and a half. Here we go. And on the bottom part, again, I want to recheck the chart. I don't want to make a mistake. 238. Okay, so that would be 238. Okay, so 238. We don't have 38, we have 40. Okay, and then it's 35. Okay, so let me try with a 35. So I'm going to do 35 and 30. See what happens. And this will imply I'm going to have to do some changes on the call side too. So 35 and 30. Okay, 35 and 30. So let me go ahead and look at 35 and 30. So 35 is 205 and 30 is 194. Okay, so I am being penalized pretty badly on the liquidity from 1.5 to 2.6. where the 240 is much better with 2.6 and 3. Okay, 2.6 and 3. That is much more liquid compared to the one below. Okay, so I'm just gonna go for 240 and 235. Okay, that would be my choice in the bottom part. And now notice that I got $5 of strike price increments, which means that on the upper side, I will want to do 325 and 330. Okay, 325 and 330. So if we do this, we're gonna get 92 cents of premium. Okay, 92 cents of premium. Again, just to go one rule at a time, if I start with a 325, we want the premium to be at least 35 cents. We got 127. That's 5. If we look at the 240 and we look at the midpoint for the premium, we want it to be at least 35 cents. We get 280. So both sides are good. Okay. So we do get 35 cents or more, which is requirement number 1. Requirement number 2, we need to look at the risk of the trade. And the risk of the trade is set by the distance between strikes, which is $5 in both cases. So the risk, okay, is $5. And our rule suggests that what we want to see is we want to take a risk no greater than 15% of $5. Okay, so if I was to use a calculator, not really needed really, but 15% of $5, how much is that? Is 75 cents. Okay, 75 cents. And how much can we get? Well, we can get 82 cents, which is more than 75. Okay, so in other words, this trade with Costco is liquid, I should not say liquid, I should say valid. Notice that liquidity is not much, to be honest. We just saw this price point move from 70 to $1. Okay, so be picky. And what I'm going to do right now, as we speak, I'm just going to place an order, but listen carefully because I also want to talk about the risk of the trade so you know how many contracts to use. In my case, I've just used one. Okay, I'll use one contract and that's it. So I'm just going to go with a market order and, I'll get whatever I'm given. Okay, of course, with a market order, I'm going to get 26. So please don't do this with a market order. Okay, I'm just going to do it out of, practicing it, or you know what, it's painful for me to see this, so I'm not going to do it. I'm just going to do a limit order. Okay, and as you see, we saw earlier 1, now it's back to 80 something. So these things keep fluctuating, and the fluctuation is telling you that it's either fear kicking in, rising the prices of the options, or market makers changing their mind and allowing from time to time better pricing. Okay, from time to time, allowing better pricing, bringing this close to 1. Okay, so you know what? I'm just going to go for a round figure here, $1. Okay, and I think that would be a fair credit for you to ask in your limit order. I would say you are likely going to get filled if you're patient during the day, during the remaining part of the day. Some of you may be like, hey, you know what? I just want 95. So some of you may, I'll take 80. Remember, as long as you are above 75 is fine. Some of you may say, I'll take only 120, right? And you place an order, and if you don't get filled, you're okay with that. So that's fine too. So the way to do this is make sure it's going to be a day order, okay? And that way, if you don't get filled during the day, everything will be expired, and tomorrow you can reassess the trade from the beginning, just in case you have another 7% drop in the market and you want to reassess the whole setup, okay? I'm just going to click place order, but before, I just need to talk about risk. Remember, the risk of the trade is set by the difference between strikes, between the calls and the puts, and that's $5, okay? So $5 minus 1, okay? If you get filled at 1, you're going to make $100 no matter what, and if you lose 500. So 500 minus 100, that's $400 of risk in this trade, isn't it? So in other words, if you are willing to risk $400, use 1 as a quantity. If you are willing to risk $800, which is double 400, use 2 as a quantity. If you are willing to risk, more, so just do the math, okay? If you are not willing to risk $400 in this trade, then don't take the trade because this trade does have $400 of risk. Assuming you are filled at 1. If you are filled at less, you have more than 400, maximum 500. Okay, so keep that in mind. And again, notice how premium is kicking in. So you may even want to go and try 105, something like that. And by the way, if you guys are taking the trade and you get filled, just notify it on on the chat box, so it could serve as a reference for other traders in the group taking the trade after you. Okay, so I just placed the order. Of course, it's a simulated account in my end, and options trades would normally stay as received with limit orders. They only get filled with market orders. Okay, so I may or may not see this order filled, but on your end, you should have that execution at any moment in time. Okay, so if you are putting that order in, so you guys let me know in that sense. Okay. Oh, the investor scans. Okay, I get you. So Lisa, certainly, based on fundamentals, you could go ahead and plan trades. Okay, so if you want me to show that, I could certainly. Let me see what's the time. I got 5 minutes, so let me show you one example of that. Since this trade is done, I will show you one example of that, Lisa. Okay. Royce, how come my scans show no symbols? All of them accept down credit. Not sure, Royce. And maybe you want to send an email to reach@tradewithufos.com and we can send you the scans. We can send you the PDF file so you double check your rules are correct. I'm not sure why this would be, but I just ran the scan before the session started and that's what I got. Okay. Jose, if we got time, could you make a comment why we use daily and 55 chart or refer to a recorded session? Yes. So the recorded session would be the YouTube channel sharpening, and to be honest, we talked about the time frames, even though it was the intraday videos. Okay, even though this is not intraday, but it was during the intraday videos where we talked about the use of the time frames. Marcus, want to get a feel about investment and for options daily and 55s intraday and FX and futures, but there is nothing long term, right? Well, we do have long term stuff. Okay, and very quick here. Longer term edge time frames. And by the way, you guys feel free to send an email so we can send you this. Okay, but here, okay, you have monthly climates. We use the 377 for the long term. Okay, this is for the long term. Okay, and by the way, guys, just in case you guys need more structure, because of course in the YouTube channel I do my best, but there is that much we can do. But two things: March 23 to 27, we are running a live online class. Okay. Live online class where we talk about all of this. Okay, we use forex as an asset, but what you learn in this class you could apply it to all assets. And we talk about the time frames, and we talk about the monthly and the weekly and all those things. Okay, so that's one thing. And then the other thing, if you don't have time, well, all of this is recorded, so you can also utilize the recordings. But also we have on the website, if you go to tradewithufos.com/join. Okay, in that URL, we have a self-paced version of the class. Okay, it's called, I'll write it because it's pretty lengthy. So it's called Survival to Mastery Forex in Action. Okay, and the reason why I'm pointing at this is because the process that you are giving here does follow, how do I put it? A very structured approach to understanding the methodology, the timeframes, and everything else. Okay. And that is self-paced. So basically you will be using our website and watching 58 lectures that teaches you everything you need to know. And those are 10-minute video, something like that each. So you can just keep going through it at your own pace instead of watching a 2-hour YouTube video where what you want to hear happens to be minute 57, but you don't know it's minute 57. Okay. Again, it's so much I can do with the YouTube channel, and hopefully what I do helps. But we have also produced other tools that hopefully also help too in a different way, and maybe other traders too. Okay, so just keep that in mind. So anyway, before we conclude, Lisa's request. Hey, David, it's very nice to see you here. I'll take a look at your email. Okay. So yeah, so Lisa's request. Okay, so we are looking at investor scanners here. Okay, so we only have a few stocks meeting that criteria. Okay, criteria of super quick, speed of the light. So if you look at the criteria here, what is it that we're looking for in that scanner? Well, we're looking at stocks above $25 a share, with some level of liquidity, with some open interest, where options are not too expensive. Okay, where options are not too expensive. Um, uh, yeah, both criteria are for options not to be too expensive. Okay, where the close is above an average, so you are in an uptrend. Where the DMIs are pointing at the same thing that auto climate does, so you are in an okay climate. Where you are being paid some level of dividends, and you can also chart for the PEG ratio, which is a fundamental number, where the lesser the number, the healthier the fundamental health of that company. Okay, so what would I do here? In a normal case, I would use that scanner the way it is. Okay, I would use that scanner the way it is, because it will give you the cheapest options available in the market. Now, what's the thing? The thing is, right now the options are expensive across the board. Even those few stocks have expensive options. They are the cheapest, okay? They are among the 50 cheapest options in the market right now, but they are still expensive given the VIX hitting 69. So this is one of those crazy moments where I would like to invert. Instead of the bottom, I would want the top. I would be looking at options that are crazy inflated, because what I'm going to show you here, I'm going to teach this at the speed of the light, okay? Because I have limited time, but I know you'll get it, because some of you are options traders for a long time, and you know that, okay? And if you are not, please watch it, but don't touch it, because this is advanced, okay? So implied volatility greater than historical volatility, and looking at volatilities which are in the top 50. Okay, so that's going to look for very expensive options, and I'm just going to run that scan. Hopefully, it's not going to take too long, and this will return a collection of opportunities, okay, with very high levels of premium. And why is that? Well, while this is loading, I'm just going to switch to the 377-minute time frame, and here in the bottom left, I'm going to switch to the monthly time frame. So I'm going to be able to see monthly climates while I look at 377-minute UFOs, okay? And I'm going to have a series of requirements for these trades, and I'm going to use an options combination, okay? I'm going to use a combination of options, which again, I already surpassed the time, so this is going to be very challenging for me to explain this properly, because I don't have the time. But basically, while this is loading, I'll try to do my best to explain it so you get it, or maybe you can try on your own as well. Again, this is only for the ones of you that have options experience. And if you have any question, you can shoot me an email. And you know what? We are getting together on Sunday in the sharpening session. So I am happy to go over this on Sunday properly. Okay? So we'll do that on Sunday. That was my plan, by the way. So here's what I would do. Okay? So in situation like now, right, which is a unique situation to buy a stock at a very low price. Okay, but you want it to be way lower because this may continue going down given the climate in the overall market, correct? So one thing you could do is that you could sell puts below. Okay, when you sell puts, okay, what happens is that if the stock gets down to that level, for example, let's say you sell the 145 put. Okay? So if the stock drops to 145, then you get the stock put to your 145. And you may say, oh, it's fine. I'm okay with that because it's very low. Okay? Well, to me, that would be a little bit of a mistake because it's very low, but there is no UFO there. The UFOs are at the 150, so I would rather sell the 150. Okay, but anyway, in this initial explanation, let's use the 150. Okay, so let's say you are selling the 150 put. Okay, this is $13 below the current price. In other words, if that stock drops to 150, you're gonna have the stock assigned to you at a price which is discounted by $13. So as a long-term investor buying a stock with dividends, etc., you may be like, you know what, I'm okay with that. Okay, but at the same time, it's a very crazy climate to the downside. So you may say, I'm not trusting this. What if it keeps falling? So in case it keeps falling, you may want to buy the 145 against. And if you were to do that, sell the 150, buy the 145. So what this would do, okay, it's basically it will produce a small credit. Okay, it will produce a small credit, um, mm, which if the stock stays there and nothing happens, okay, you could make money on that small credit. But again, that would just be a normal credit spread, a bull put spread. So my intention here would be that instead of doing this times one, let's do it times two, just to increase the total amount of credit. Okay, so we will do this times two. Okay, times two, and again, the good news is that the most you can lose is $5 times two. Okay, so you have $10 of risk. Okay, which by the way, $10 of risk is less than the risk you would have buying the stock now and the stock falling to 150. Right? So in this case, you got $10 of risk. That's the most you could lose, even if the stock goes down all the way to 20. It doesn't matter. The most you can lose is 10. So it's you have some safety net built in. But really, my intention here of getting that credit, and that's why I said let's go for double of this, is not really to make a profit, which is the credit. My intention is to use that credit to going ahead, and maybe, I don't know what the option chain will allow us to do, but maybe I can go ahead and buy the 165 call. Okay, why? Because if this never dropped to 150 and starts moving up, and next thing you know, reaches 170 1 month from now, 2 months from now, 3 months from now, well, the credit spread will expire and you keep that premium, and the call you bought at 165 is paying you money. Okay, so if it goes up, you make money. But what if it does go down? Well, if it goes down, you know the most you can lose is 10. Okay, but below 150, you got the stock put to you. So what would happen is that you have acquired that stock with insurance, where the most you can lose is $10. But now if that stock bounces and go back up, you are in business, and you are in business starting at 150, not at 163. In other words, if it goes from 150 to 155, which could be seen as a small move given the current volatility, well, you just made $5, okay, and you save yourself a $13 loss. So again, that's a nice application, okay, but we are not having too many stocks meet that criteria. Actually, it's the same stocks we had before, funnily enough. So notice how the scanner was looking for cheap premiums, but even though the scanner was looking for cheap premiums, the fact is that they are all so expensive, with the VIX being 69, that I got the same stock again. Okay, so basically I got CLX, then TLT and IEF and SHY. They are all ETFs. So the only one who is a stock is CLX. Okay, so then I guess we should chart CLX, and therefore that's the chart. Funnily enough, okay, I'm not happy with 45% though. That I'm not happy with. So I will want to look at pre-post market to see if I got more. I got worse. Okay, so that would not be good. And basically, this trade is not to be taken. Okay, so you will want to wait, look at it tomorrow again, see if you have an opportunity. Okay, I'll just look at the option chain. By the way, anyone got filled on the Condor? I'll just look at the option chain to see if we can do this application. Okay, so you get to see it. Okay, so I'm just gonna go out. Let's say 50 days. Okay, so I'm just looking at premiums. Yeah. So if I do 150, okay. So if I do 150 and I do 560, okay. So how much is that? Well, let's grab the calculator. So 690 minus 560, that is 1.3. Correct? So if I do this, yeah, that's not good. It's not good. And here the problem I have really is also lack of liquidity. So let me see, maybe if I do the monthly, 150, this is much better. Much better. What about the next monthly, which is July? 150. Yeah, I'd rather do this one 36 days. So if you do 150, okay, you are going to get paid 5.75. If you do 145, you're gonna pay for 75. That's $1. Yeah, it's about the same as before. I didn't look at it correctly earlier. So let me take a look at the July again. So yeah, 11 and 9, that's $2. Okay, I like this much better. So 11.8 and 9.8, that is $2, isn't it? So in other words, if I do this times 2, okay, if I do this times 2, I'm getting $2 and $2, $4. Okay, so in other words, I can turn around and buy the 200 call. Okay, I can turn around and buy the 200 call. So let me do this. I'm gonna analyze and buy butterfly. I don't want a butterfly. I just want 3 legs. So I'm just gonna make it custom. And what I'm gonna do here is the bottom part is gonna be puts, the top part is gonna be calls. Okay, so if I sell the 150 and buy the 145, and then I buy the 200 call, okay, this trade can be done for a credit of 25 cents. So you do this trade and you are being paid 25 cents. In other words, nothing happens, it doesn't go up, it doesn't go down. In the end, you make 25 cents. I mean, that's not the plan, really. It goes down to 150, and now the stock is put to you at 150. Okay. If it goes higher, you have a 31 delta with a positive gamma that will improve the trade as the stock goes higher. Okay. So even though the 200 call is far out of the money at this moment in time, it would start picking up value at an accelerated rate because of the positive gamma. And you don't need to reach 200, but whenever you reach a good target, okay, which could be set, should be set, by the way, using AutoUFOs on a monthly time frame, so then you could be out of the trade and done with it for a profit if it happens to go up all the way. But anyway, that 45 invalidates everything I said. Okay, so basically, hopefully, Lisa, I just open your eyes a little bit to what we're doing. It's not really a bag ratio, okay, because a bag ratio would use only one put short and multiple put longs. In this case, I'm using the same amount of puts and long and short. So I have one call and then 2 and 2 for the puts. So it's not a bag ratio. It's a fun combination. Let's call it like that. And certainly is quite safe to play, but it doesn't work well with CLX, given the premiums, given the liquidity, and the worst part is the UFOs are 45%, which is not enough to pick up direction. Okay, so it doesn't work. But again, we'll talk more about this on the weekend, and we can do this more efficiently. Okay, and Mark, I can see you typing there BFF, which yes, you're right. A well-known person that we both know used to call this the breakout for free, right? The BFF, but really it's not like that either, because the breakout for free strategy would imply not using that bottom put. It would only be sell 2 puts and buy 1 call. And in other words, you have unlimited risk to the downside, which I would not welcome in such a market as we see right now. So I'm just adding additional protection, which makes the trade more difficult to work or end up working with less delta. But it also adds more protection, which certainly would be my approach in trading. As always, safety goes first. Okay. Yes, absolutely, Lisa. And we can also look at the down scan too. Yes, very well. No problem. Cool. Very good, everybody. So, hey, I surpassed this, the time of the session by 12 minutes. So I'm just going to cut it here. Session is over, my friends. A pleasure to join you. And again, stay safe. The market is not a joke at this moment in time. And the market is never a joke, but certainly you know what I mean. So stay safe, and I will see you on the Sunday session. See you then, everybody. Take care. Bye-bye.